Hi everyone, my name is Darryl Panes, CEO of As Good as Gold Australia, and this evening once again I'm joined by my brother Brian,
Thank you, Darryl.
partner at As Good as Gold, and tonight we interview Alasdair Macleod, advisor to As Good as Gold Australia. Good evening, Alasdair.
Good morning to you. It's good evening to you. It's good morning.
Yes, it's good evening here. Good morning to you.
Always a little confusing. Welcome back, Alasdair. It's the new year. It's our first interview for the year, of course. With yourself, but I think the year's going to be full throttle. I really do.
There are so many things that are happening out there that I have to agree with you. There are many things that could happen. Black swans, doesn't matter. There's wars going on. There's inflation going on. We'll be talking about all that today.
Look, history confirms, Alasdair, that we have a financial crisis about every 10 years. Last time, of course, was GFC, 2007-8 through 2011. So based on that, and it being 2022, we don't have long to wait. Right now, we're experiencing higher levels of inflation. All markets, and that's something we'll be talking about tonight, all markets are in massive bubble territory. We've got stock markets, all-time highs. I mean, it's perfect, the perfect environment, isn't it, for gold? Property values at unrealistic levels and the bond market in disarray. We've started the year in the US with the latest numbers confirming that inflation, the inflation rate has accelerated to 7.5%.
Correct.
Now this is just confirmed a couple of weeks ago in January of this year. The highest it's been since February of 1982, so it's 40 years. My question is, how is the bond market going to react to this inflationary trend? So currently investors purchasing bonds are looking at approximately a 2% yield. Inflation is running at 7.5%. So the real return at that is -5%. So there's some pretty savvy investors out there looking for better returns. So they're going to go to stock market, they're going to look at alternative investments. One would think that, and here's the question, one would think that bond yields will have to rise above the inflation rate. So could we be looking at 8 to 10% to return 1 or 2% to the investor? So Alasdair, how do you see this playing out? And what would the ramifications be on the economy if anything like those numbers was to take place, considering, of course, the level of debt, unprecedented debt levels in both government and private sectors? What are your thoughts?
You're absolutely right to focus on the very high level of negative real yields. It's a situation that can't continue forever, obviously. It only continues for as long as the establishment central banks can sit on rates. The reason they have to sit on rates is because, having distorted the market, they can't allow markets to come back, as it were, and have a true reflection of the situation. I mean, just imagine with all the malinvestments, the non-productive debt in the private sector, which has been taken out on the basis that interest rates have been anything from 0 to, say, 5% over the last 10 to 15 years. I mean, it's completely unrealistic with prices having moved up, as you rightly point out, in the United States officially by 7.5%. I mean, we could go a bit further and say that unofficially, I mean, if you look at shadowstats.com, they're saying it's 15%. Okay, give or take 10%, we're up at least 7.5%. And as you rightly say, that implies a negative real yield of at least 5.5%, at least 5.5%. When it comes to government finances, of course, the assumption is that governments can continue to borrow at these very low interest rates. And if interest rates rise as implied by very high negative real rates available on their bonds, then that is going to disrupt government finance. And if you disrupt government finance, coupled with the problems in the private sector from rising interest rates, you have got a global economy, because it's not just America, a global economy that faces what Keynesians call a recession, a slump, a depression, however you like to call it. I prefer to just describe it as a downturn in economic activity, as the malinvestments are sorted out. I mean, what Joseph Schumpeter described as the process of creative destruction, that has got to take place. And the whole objective of monetary policy is to stop creative destruction taking place. And it's been like that. And the result is that the distortion has just built up and built up and built up. There is another aspect which nobody is talking about, and I've been researching it for my article for Gold Money, which is being published tomorrow, and that is the situation of the central banks. People seem to think that the cycle of credit, the boom and bust, as it were, is something that is restricted to the commercial banks. So far, yes, that is true. But we now have a difference, because the central banks now own an awful lot of bonds. So we need to think now not just about the effect on the commercial banks and how that interacts with the real economy and so on and so forth. We ought also think about the situation for the central banks. Central banks now have an enormous amount of their government debt on their balance sheets, which they're carrying at very, very low interest rates. So if you get a rise in bond yields, in the yields of the bonds on their balance sheets, that means that on a mark-to-market basis, the value of those bonds falls. Now, this is actually sort of hidden. It's hidden in two ways. I mean, the Bank of England hides it because they have an off-balance sheet special purpose vehicle which holds all these bonds. And under previous chairmanship, I think going back to the time of Lord King, when QE first was introduced, the Bank of England managed to negotiate with the Treasury that any losses on QE be reimbursed to the bank by the Treasury. So the result is they don't have to carry a note in their accounts saying, we've got this elephant in the room. Yep. I mean, so far, we're looking at potential losses in the region of £100 billion for the Bank of England. It wipes out, if it was accounted for property, it would wipe out all the equity on the Bank of England's balance sheet many times over. If you look at the Fed deals with this in a different way. And in a sense, it is justified, because the average maturity of US Treasuries on the Fed's balance sheet, I don't know the exact figure, but the US Treasury market tends to have a shorter overall maturity than most other bond markets or government bonds. What the Fed does is it carries the US Treasuries and agency debt on its balance sheet at its face value. So you just don't see what the true value is. Again, the rise in yields so far has wiped out all the equity on the Fed's balance sheet. The same is true of the Bank of Japan, which, famously has got huge amounts of government debt. It's been doing QE since the year 2000. It was the first central bank to do QE. And not only does it do QE, but it also invests in ETFs in the stock markets, sort of equities. So it's carrying equity investments on its balance sheet as well. So that is, again, it is seeing its equity wiped out. The effect at the moment is marginal, because what happens in the JGB market is that we're looking at rates, say, on the 10-year JGBs, which have risen from a low of about 0.03% to 0.22%. The price effect of that is obviously not nearly as great as you have seen in the US Treasury market, where even on the 5-year bond, the yield has risen from around about, I think, sort of 0.4, something like that, or lower, and it's now currently running at just under 2%. So there's a bigger price effect on that. But the real horror story is the ECB. I mean, that is staggering. The problem that the ECB has is that it hasn't got a government to rescue it from negative equity. It is already in negative equity, incidentally. And then you've got the position of the national central banks. The Bundesbank is deep underwater. I mean, it really is, hugely. I mean, we're looking at in the world of commercial banking, we sort of see asset to equity ratios of, sort of 10, 11, 12 being really sort of a bit on the rich side. And, it's a setup which is going to end up in a crisis. I mean, but in the central banks, I mean, to see asset to equity ratios of over 150 times is not unusual. It's commonplace. So it doesn't actually take very much of a rise in interest rates, a rise in bond yields, to wipe out the central banks. Now, I don't know how that resolves. I mean, I can see in the case of the UK, the Bank of England turns around to the Treasury and says, well, thanks very much for the guarantee, we're calling it in. And what will happen is that the US Treasury won't sort of start sacking workers to pay the Bank of England's bill. It'll tell the Bank of England, well, you just borrow more so that we can pay you, And I mean, the whole situation, I mean, I can see how that one would be resolved, if you like. That's what basically will happen. But, anyone who's got an ounce of common sense sort of sitting back and thinking about this will think, oh, hold on a minute, this is a complete bloody scam. We can't go on like this. I mean, what does it mean? Does it mean that the Bank of England as a counterparty, I've got pound notes and, 10-pound notes or 20-pound notes. That is my exposure to the Bank of England. Should I trust that if this is the sort of game they get on with? And yep. I mean, if that's bad enough, I mean, the position in the Eurozone is, it is horrific. I mean, there's the only way to describe it. And without having a bank, as a government to turn around to and say, well, it's not a problem because, the German government has guaranteed our equity. Hold on a minute. That is not the situation. Nobody is guaranteeing the ECB's equity. And if you think that Brussels is going to come up with the money, I mean, forget it. They couldn't organize light refreshment to a captive audience. So the whole of that situation looks like being a fiat currency catastrophe. And then what happens to the banks? I mean, if we start getting these sort of counterparty failures with the central banks, nobody's going to start dealing with the commercial banks in the Eurozone. And if they haven't gone bust by then, they will go bust. And also, we've got the situation of the repo market, which, as I've said before, in the Eurozone is well over 10 trillion euros. That basically is going to go overnight. Now, that's a bank credit contraction of over 10 billion euros, like that. So, this is not looking good. And I mean, it makes me think that, these rising bond yields, getting back to your point, Darryl, has actually got these unexpected consequences, which we're not really fully thinking through. And it tells me that once this house of cards starts falling apart, I think the falling apart will speed up and it'll be a very, very rapid event. So the time, we don't have the time to be able to sort of sit down and say, well, we can see this, we can see that, and so on. And so we can plan for the future. I mean, we're running out of the sort of time when that's the case. And to get to your point about the crisis repeating, sort of with regularity every decade or so, the point about a crisis is that you wake up one morning and say, oh my God, what's happened? Overnight something has happened. And, and it doesn't have to be a war with the Russians in Ukraine or something like that. I mean, it can be a financial thing. It can be rather like the Creditanstalt failure in 1932. Suddenly a relatively unknown bank falls over and then the whole banking system collapses. So I don't know. I don't know what will trigger it. But what I do know is that the more I look into this, the greater I see the dangers being.
Is there any way of avoiding a total collapse? No.
Yeah, I don't see it, Darryl. I mean, what's happened in the past is, it was the phrase which was so common at the time of the Lehman crisis, kicking the can down the road.
Yeah.
And, there comes a point where, your toe caps are worn out or whatever. I wouldn't really like to mangle that metaphor. I just can't see how they can escape from this one. I do remember in the Lehman crisis, there were a few moments where you sort of sat there and thought, oh my God, you really saw the downside in the whole situation, the possible collapse of the whole system. And it was very, very close. I'll tell you an anecdote. We've got journalists in this country who used to write for the Financial Times, a guy called Robert Peston. And at that time, he interviewed John Paulson, who was the Treasury, I can't remember what his position was, Treasury Secretary or something. It was something like that. And Paulson, when he saw this thing falling apart, he actually went down on bended knee to try and get, government to agree to the Fed taking extraordinary measures and bailing out the whole system. The other thing that came out of this was that because China was a major creditor of the United States, it was important, obviously, for Paulson to keep Chinese updated. But what came out of that, and this was in the interview with Peston, but it was never reported, but Peston himself reported it separately, was that, the Russians were all for pulling the plug, whereas the Chinese thought, no, we'll cooperate. Interesting parallel. It just shows how close we were to a complete disaster. The situation is far worse this time. And as I say, the situation with the central banks, I think, is a completely new dimension and very, very concerning. The one thing that the Bank of Japan has said is they have gone on record of saying that if the yield on the 10-year JGBs approaches 2.5%, then they will intervene very heavily. They will buy in other words, they'll underwrite the yield at 2.5% and not allow it to go any higher. Now, what that tells me is that, yes, it confirms my analysis of their position, one. And secondly, it tells me that being driven into a situation where they have to contain the rise in interest rates, interesting lesson for everybody else, incidentally, in the central banking world, they are in effect committing to undermining their currency in order to stop interest rates rising. Now, that's a frightening statement if you think about it. So, the crisis has really got, in that sense, two halves to it. At some stage, you've probably got bankruptcies, whatever, but you've also got the response of central banks, which will be basically to sacrifice their currencies. That is what the Bank of Japan is telling us.
The scary thing about all of this is that most people are oblivious to what's really going on. Reminds me very much of the Roaring '20s leading up to 1929. I can see now similarities and why as many people get as hurt as they do. They just don't see it coming. In fact, it's quite the opposite. They're overspending, overcommitting, and then the wheels just fall off, don't they? Mm.
They know their house, the value of their house and the value of their portfolios are, sort of up there somewhere. So, they feel quite comfortable spending.
Yes.
But to your point about the end of the Roaring '20s, there is another comparison, and that is with the South Sea bubble. At that time, I can't remember the exact name of it, but there was a company floated seeking subscribers whose prospectus basically described it as a company to engage in activities which nobody is to know what they are. Something like that. But that is basically these, today's SPACs, special purpose acquisition, corporations, whatever they call them. It's exactly the same. I want to just raise some money. I'll issue this SPAC and get all the money in, and then I can play with it. That basically is exactly the same. And you get that at the top of a bubble. And I was sort of reading an article in somewhere that these SPACs, are now being pulled because nobody's buying them. So it's interesting. I mean, we could well be already over the top and looking at the other side of the bubble, which is, of course, something that goes pop. And again, I mean, this is why interest rates are so vital. And to remind your viewers, I mean, the purpose of interest rates is not to price money. The purpose of interest rates is to reflect the market expectation of the purchasing power of the currency in the foreseeable future. So 1 year money, basically, to your point, Darryl, should actually compensate you for the loss of purchasing power, which so far we know to be 7.5%. Now, if we believe what central bankers are telling us, that this is just a temporary thing, transient or whatever, it might be a transient for a little longer than we originally thought, then you don't worry about it too much, maybe. But if you suddenly suspect that this is going to stick around a bit, if you don't buy the Keynesian Kool-Aid, then you're not going to want to hold dollars, that's for sure. You're not going to want to have them to lend to someone else because you know that the purchasing power of your dollars is not going to be compensated for. Yes. And that is the point about interest rates. So it's not that interest rates price money. The idea that central banks can use it as a tool to manage economic outcomes has got the whole thing back to front. I mean, it really has. So their policies will fail for that reason. I mean, it's quite simple. Everything they have done is actually wrong. They've got it completely wrong because they've bought into this Keynesian thing, where the state actually not only has a role in the economy to manage it, but can manage it successfully. All they've done actually is that they have printed currency and credit at our expense, the people who are being managed, in order to manage outcomes that look good for the central banks and governments. That's all they've managed to do. And of course, it leads to periodic disasters. And it looks to me as if we're really on the verge of another one.
Yeah. And this time the GFC, of course, was somewhat localized. It was more about America, the US. But this is a global issue. I mean, this is much bigger than the GFC.
Yeah, and the America had a lot less debt at the time, around 2008-09. So, we're doubling the debt level of the United States is doubling the debt level every 8 years. So it's been well over 8 years since that. Yeah. I'll just try to look at summarising all of this for our clients. I see where the central banks are between a hot rock and a hard place. I mean, first of all, they create extra money. They shouldn't really do this, but they print the extra money to keep the economy moving along. But the same amount of goods are produced, so that extra money out there is sloshing around. Same goods are produced, so that means the goods go up in price because that's where the money goes for. So we create an economy which is slush with money. Then we have to raise interest rates. We have to raise interest rates to stop their slushing of money being printed. But if you raise it up too far, what it also means that the governments around the world are paying higher interest rates on their debt levels. So this does not end very well. Just be very careful, clients, to as good as gold. I suggest, like we always do, put a little bit of your excess cash, if you do have any, into gold and silver.
In the metal.
Yeah, into the metals. Alasdair, I just want to bring up something on instant gratification. I got this article out of Egon von Grass' website, and he said that there are 5 American companies that began after 1994, 30 years ago, and their owners' net worth adds up to over $807 billion, which exceeds the GDP of Switzerland, Holland, Sweden, and Poland. Now, some of these countries are over 1,000 years old. Alasdair, do you believe that the printing of currency by the Federal Reserve has put a question mark over the dollar's worth or its value? What are your comments?
Well, of course it has, yes. I mean, the amount in circulation is just absolutely enormous. But, I mean, they've been following policies which, are just, if you just stand back and just apply a little bit of common sense, are absolutely balmy. I mean, they seem to think that GDP is a measure of economic progress. It's not. I mean, they don't call it progress. They call it growth, economic growth. Right. It's not. It's a measure of monetary growth or currency growth, currency and credit growth. Yeah. And so the more currency and credit that's produced in an economy, the more GDP goes up. Does that mean the condition of underlying people is improved? No, it doesn't. It's a completely separate issue. Mm-hmm. And of course, what happens is that if you have an unsound money environment, which is really what we're talking about, then some people will do extremely well out of it. And the majority of people will lose. And that's basically what's happening. Now, how bizarre is this? The central banks seem to think that by debauching the currency so that prices rise at 2% per annum, that will stimulate economic activity. Mm. But hold on a minute. Actually, what they're doing is they're taking wealth away from the private sector, handing it to themselves and the government, and letting the private sector perform on 2% less resources, capital resources, year in, year out. Mm. I mean, I'm sorry, but this is just complete nonsense. Mm. Yeah, I mean, you're right, it can't work. And I think the other way which actually helps people to understand this a bit better is not think in terms of prices rising being inflation. No, it's not. That's a symptom of currency debasement. And I think if you always look at it from, actually from the currency point of view, what's happening, rather than from the price point of view, then you begin to understand that actually this currency debasement is the engine of everything that's happening and going wrong. Mm. It's also the engine of financing government spending shortfalls shortfalls on their taxation. And of course, it suits everyone because it robs savers, benefits borrowers. So everyone from companies raising money to invest in production or raising money to buy their own shares or whatever it might be, to people speculating in the stock market. I mean, the amount of margin debt in the US stock market at the moment is over $900 billion. I mean, it's just, the world is awash with unwanted currency. In an economy where you have sound money, or the money that you use, the currency that you use is properly backed by sound money at the user's option, not at the state's option, then under those circumstances, you don't need a huge amount of currency. It will circulate and do its job, but the quantity is really set by the people, its users, not by governments. And that's where the whole thing is going wrong. This is going to end, I'm afraid, with the end of the fiat currency system. And, my comments about the situation with central banks, which nobody's looking at. I mean, look, for example, at the situation in Zimbabwe. We know that the Reserve Bank of Zimbabwe, or whatever it's called, comes up with some unconventional policies. Let's put it that way. Now, what do we think about that? Well, we know that what will happen is that the Zimbabwean dollar goes down the toilet. But nobody ever seems to think that actually the central bank is likely to go bust. It's assumed that will sail on forever.
Yeah.
And that's exactly the assumption we've got today with the central banks which dominate the global economy. The Fed, the ECB, Bank of England, National Bank of Switzerland, Bank of China, Bank of Japan. I mean, all those banks basically have loaded themselves up in a bubble with financial assets. And as that bubble implodes, it's going to take them out. And they're the people who produce the currency.
Yeah.
So, and there's no backing to it. And I was first alerted to this. I was reading some time ago, I was reading a biography of John Law, the Scottish adventurer who overturned the French currency and economy back in 1720. He started because what he did. I mean, not only did he manage to sort of turn his bank into a prototype central bank. It went from Banque Générale to Banque Royale, literally, with the King's Bank. So not only did he manage to do that, but he also became controller of the currency. So in other words, with Parliament's approval, which he got through the Duke of Orleans, who was very much on his side, he could issue more or less any currency he wanted. So when the calls came due on his Mississippi venture, and people started selling shares in the market in order to pay the calls, and thereby driving down the price, what did he do? As controller of the currency, he printed currency to buy the shares. And the person who actually understood this and got it totally right was a chap called Richard Cantillon, who was an Irish-French banker, who didn't short the shares in the Mississippi venture. What he did was he shorted the currency on the foreign exchanges in Amsterdam and London. He just sold all the French livre he could possibly lay his hands on. And of course, he was right, because the French livre, by sort of September 1720, which was roughly 6 months after the scheme of arrangement putting together the Banque Royale and the Mississippi venture, which was due to happen at the end of February 1720, by September, there was no quote for the French livre. It was worthless on the foreign exchanges. And we have a similar situation today. What is QE? It's going into the market and buying your own stock. In this case, we're talking about government bonds to keep the prices up. That's what they're doing. And sooner or later, this goes wrong. As the ghost of John Law, I'm sure will be very happy to tell today's generation of central bankers. We're in exactly the same situation.
Yeah. We haven't learned a thing in 300 years. Have not learnt one little thing from the banking. Yeah. Oh, dear. Well, that brings me to the next question, Alasdair, because I'd just like to talk about, just very quickly, it's all around the stock market. And interesting enough, the Dow Jones has been bumping along between 34,000 and 36,000 points for the last couple of years. Nobody talks about that, but if you put your money into the Dow Jones, 2 years ago, you wouldn't have made a cracker at the moment. And generally, when you don't make a cracker or you don't make anything, you usually lose. It's not the other way around that you usually lose. So, what is going to happen? Because Egon von Graz again brought up a good point. He's talking about buying the dip will fail this time. A lot of people think that 5% retraction of the stock market, maybe 10%. Wow, let's dive in. Let's go in. It's down 10%. Right. I don't get that feeling anymore. Darryl and I certainly don't get that feeling. We think it might go down to 30%, 40%. So buying the dip this time will fail. What do you think?
I think you're probably right. And the reason I think you're right is, again, we come back to interest rates. If interest rates are going to rise far higher than currently discounted in the markets, then it's quite simple. Equities will will fall, and not only fall, they will probably collapse. And I mean, I can see, the situation is very, very different from the 1929 to 1932 times when money was sound because you could exchange your dollars for gold at the rate of $20.67 for an ounce of gold. So the price effect on the stock market was very different from this one, because basically after that very sharp downturn in the beginning of 2020, which actually replicated the Wall Street crash in September to October 1929, it was almost that to a T. Like the market lost 30%, just over 30%, in 5 or 6 weeks, literally. We forget that now, of course, but anyway, that is what happened. And what did the Fed do? The Fed, at that stage, under the cover of the COVID situation, cut interest rates to zero and instituted QE of 120 billion a month. And so far, I mean, basically, they've added over 2 trillion to their assets through QE since then. And it's under that influence that zero interest rates, which means the cost of borrowing to speculate has gone way down, robbing savers, if you like, and this QE of 120 billion a month being injected into financial markets is what has made the difference between the subsequent collapse that we saw following the initial rally from end October 29 through to about May 1930. And that was when President Hoover then signed the Smoot-Hawley legislation into law. The US stock market then started going down and eventually lost 90% from top to bottom by the middle of 1932. We actually have that second leg, but the distortion is we can't measure it because of the changing value of the dollar. But of course, nobody looks at that. You know, they think the dollar is the constant in every transaction, and whatever it is, whether you're buying copper or shares or whatever, that is the variable. That's not like that anymore. And as soon as people realize that it's the currency that is the variable rather than the other, then currencies are doomed. And with everybody really long of equities, I think there's only one thing can happen. And that is, despite the falling purchasing power of the currency, rather like the John Law situation, the prices of equities will fall. So in real terms, it's a bit of a double whammy. I mean, the other bit about the John Law experience in 1720 is that the Mississippi shares fell from about 11 to 12,000 livres down to around about 3,000 or 4,000 livres over the period. But the livre was worthless. The shares retained some notional value in France, but not elsewhere because they were priced in valueless livres. And it was the livre that went. So, the more I look at it, the more I think that that is probably the template for what's going to happen in stocks, as well as the currency. Yeah.
So in summarising that one, I would think that, Darryl, that if you're in the stock market and you've been in there for a little while with the Dow Jones not doing anything, I suggest we pull out and put it into something a bit more solid and concrete, being gold and silver. It's just, it's the only money. It's been there for 5,000 years, and it just keeps on going up because they print more money.
It has proven the test of time, and governments and central banks have continued. You're right; they've not learned a lesson. They think they're a little smarter now and can and can manipulate in a smarter manner, but it all ends up with the same result.
Same result, exactly.
I should say that I don't. Yes. I should say that I don't give investment advice. Don't take what I say as investment advice. I mean, it's up to people to make up their own minds on this. Yeah. The only thing I would point out, as we've discussed before, is that the difference between physical gold and physical silver and the ephemera in the stock market is that the ephemera in the stock market are investments. Just the same as investing in a mine is. It's an investment. But gold and silver, physical gold and silver, are money. and it is the most secure form of a medium of exchange, and you don't speculate in money.
No,
a mistake a lot of people make. I mean, a lot of the people who sort of think that gold's going up or silver is going up, they can't get out of the mindset where they sort of think, I'm going to buy gold, say at 1850 or whatever it is today, and I expect to be able to sell it at 2050 in 3 months' time or whatever. They look at the charts and all the rest of it. Yeah. One thing that they fail to understand is that it is not gold going up, it is the currency going down. And I think as soon as you grasp that properly on board, then you're looking at it the right way around. That's the important thing. We're talking about money here. We're talking about money that eventually will be spent, not cashed in at a profit.
No, 100%. Yeah, I agree with that.
I agree. We've been talking about central banks tonight and some of their indifferent policies. However, Jim Sinclair, and we have an enormous amount of respect for Jim, constantly refers to owning gold, as do the central banks. So they do. Why shouldn't we? Or why shouldn't you? That's one thing that they do, and I understand why why central banks own gold. My line of thought is it's all around confidence. It's all about confidence. It's all about supporting the currency. An unbacked currency in real terms could be seen as being worthless, which is when you see it littering the streets in places like Zimbabwe, etc. Yeah. So my question, I guess, here, Alasdair, is this. I'm referring to Jim Sinclair's reference. So I'll ask you, why do central banks own gold? And why should we follow their lead on this one and only policy? Right?
I think it's a very good question. I think the answer is that it depends how Keynesian the central bank is. I mean, if it's completely Keynesian, like the Canadians, they see no reason to hold any gold whatsoever. I think there are a lot of sort of people in the middle ground. I mean, by people, I mean in the central banking world, who are in the middle ground, who understand that physical gold is no one else's liability, whereas the dollar is a liability of the United States, and so on and so forth. So, on those grounds, it makes sense for them to hold gold. I mean, there are very, very few central banks which really are, if you like, promoters of sound money or understanders of sound money, but they are in there. I mean, I've met a few in the past, particularly in Middle Europe, who've learned the lesson from the days of communism, perhaps, understanding the importance of banking stability and currency stability. And I think this is also true of a cadre of sound money people in the Bundesbank. And I just note with great interest that Jens Wiedemann, who was very definitely a sound money man, sort of resigned last year. Now that I've looked at in detail at the situation on the Bundesbank's balance sheet, I can understand that he wouldn't want to have part of this at all. So, there are a variety of opinions. And then, of course, the other thing is that laws come into it. I understand that the situation with the Italians, the Italians hold, the Italian central bank holds huge amounts of gold. I can't remember the exact figures, but places Italy in the sort of top 5, if you like, of, and they've got, the most appalling economic performance. It's mismanagement and all the rest of it, but they still hold on to their gold. But I understand that there is a thing in Italian law that the gold was actually taken in from the commercial banks into the central bank. So the central bank is in the position of being a custodian of the other bank's gold. So legally, they can't really sort of just dump it. But it also raises, I think, the possibility, and we must be aware of this, that as central banks get into difficulties, that they will dispose of some of their gold in order to try and get out of their difficulties. And they will probably, at the same time, some of them will want to drive down the price of gold, because gold, if you like, is an indication of loss or changing confidence in fiat currency. So if the gold price, goes through the roof, I mean, it's not exactly sending a good message about central bank currencies. So, so there are a number of things, I think, to consider along the line. It's also not impossible that, a central bank and backed up by its government will introduce restrictions on gold ownership. So under those circumstances, you could find that if you want to buy gold, it's an illegal act. It could be that actually owning gold is an illegal act. I mean, that was the situation following the Roosevelt move, the executive order in 1933. I happen to think that nowadays, any government doing that, basically, you find that people would they'll just clam up, they'll just hold on to their gold and say, I haven't got any gold. Go and talk to someone else. So. Leave me alone. Stop pestering me. Yeah. I don't think people are so compliant as they were in those days. I think that's the important thing. So, I mean, all these policies would just make the situation worse for the currencies. So, I think this is the other thing that we need to know about owning gold and silver, and that is, it's not necessarily going to be a smooth ride, but it's the only way in which, once the whole thing is sorted out, you're going to have anything left. This is if we get a collapse of fiat currencies, which I fully expect. And I do understand that is an extreme position to take. But I feel quite comfortable taking it. Other people might not feel comfortable going along with that argument. But I would still say, don't use that as an excuse to say that, gold ownership is blown up by the gold bugs and, I'm having none of it. I mean, I think that would be a very foolish thing to do. We've used the phrase before, insurance policy. Have just a little bit of insurance policy. And the difference between this and an insurance policy is an insurance premium, once paid, is lost. This insurance premium, you retain.
You retain, exactly.
Yeah. I do have one question.
And
it's on the central bank issue with gold. I know that there are a number of countries at the moment that have been on big buying sprees for gold. India just recently, it's just been confirmed that their Reserve Bank, the RBI, has purchased 77.5 metric tons of gold in 2021, which is their second highest, biggest purchase ever. And of course, we know Russia and China are seriously in the gold. Interestingly enough, if I can ask you this question, it's just come to mind, Alasdair. What would happen if they opened up Fort Knox? Now, Fort Knox, 1953 was the last time they had an audit. What would happen if they opened it up? And it's been resisted many times, of course, because the question's been asked on numerous occasions. But if they did, and there was nothing inside, what would that do to everyone's confidence in the American dollar?
Well, it would completely undermine confidence in the dollar. I think it's as simple as that. Because what it would confirm is the suspicions that the Americans basically have tried to suppress the price of gold by leaching into the market to try and keep it down for the last 40 years. And interestingly, on this one, there was an analyst called Frank Veneroso who, at a speech in Lima in 2002, said that he estimated that between 10 and 15,000 tons of central bank gold was subject to leases into the market. In other words, at that time, what he was saying was that up to 50% of the gold reserves in the world's central banks and treasuries didn't exist. It wasn't there. And I think there's, the scenario that you've painted is entirely consistent with his analysis. Now, I do know that Frank Venerosa spoke to an old chum of mine called Terry Smeaton, who was the head of foreign exchange at the Bank of England in those days. I mean, Terry's now dead. I used to lunch with him occasionally. I just wish I'd asked more questions. And so, I mean, he was getting this information in those days. This information wasn't deemed so incredibly sensitive that, the Bank of England would just sit on all information. Terry was, sort of quite open with Venerosa, from Venerosa's accounts anyway, about the scale of leasing that was going on. And of course, this is another thing which the IMF accounting practices, which, the IMF, if you like, sort of provides the accounting framework with respect to the gold holdings in the central banks. It says that, gold which is out on lease or loan or swapped or whatever can be included in a central bank's records of its gold ownership, of its physical gold, because obviously at some stage, under the obligation, it's going to return. But what it leads to is a huge amount of double counting, because the banks which have maybe, if central bank A has leased gold from central bank B, it has increased the gold in its ownership. So how's it going to account for that? It will probably make a return that it's got, what it had before, plus what it's got, subject to lease, which has come in. So there's a lot of jiggery-pokery going on with the accounting in these central banks.
Yes.
And I mean, the idea that that 10 to 15,000 tons has sort of all come back. I mean, the one thing I would say is that practices have changed somewhat, but not entirely. I mean, we had a situation where GLD, the big ETF, suddenly reported, I think this was August 2 years ago, when gold spiked up to over 2050 or whatever. They reported a sub-custodian being the Bank of England. In other words, what had happened was that there wasn't enough gold in the market to satisfy the purchases of people who were buying shares in this enormous ETF. So they had to borrow it from the Bank of England, but the Bank of England wouldn't let it outside its vaults. So it became a custodian. Now there's double counting. Who owns that gold? I mean, it was probably owned by a central bank. And I had an interesting situation, because I had a friend in Finland who was who became an MP over there, and he helped me translate a blog of the head of the Finnish central bank, and that blog said, they were very proud that of their 62 tons or whatever Finland owned at the time, they had over half of it out on lease. This is what he said in the blog. So I reported this, and it caused a bit of a kerfuffle. And the next thing we knew, the blog had been taken down. So you can see, the Bank of England basically acts as a ringmaster for providing liquidity in gold to try and sort of keep some control over the price. I mean, I don't know, that's definitely the objective, but I think we can be pretty sure that that's the objective. They don't want to see the price run away. I mean, whether you say it's because it sort of upsets the confidence in the fiat currencies, or whether they're just concerned about the short positions of the bullion banks and don't want to exacerbate them. I mean, it doesn't matter. I mean, for whatever reason, they are sitting on the price by synthetically expanding the quantity of gold. And I think, coming back to your point about the US gold reserves, US Treasury gold reserves, I mean, over the last 40 years, anything can have happened. And I would not be surprised if, as you say, they threw open the gates and all you found were a few sort of dead spiders.
Alasdair,
I've got
What
to
are you gonna say?
President de Gaulle, tested them out in 1965, didn't he?
He certainly did. Yeah.
And sent a warship to the United States, as we know, because he said, "I do not trust the American dollar, I only trust gold." Sent a warship to the United States, did the exchange at $35 an ounce. And the problem was, of course, there were a number of other countries followed suit, and it was quite obvious that the Americans had overprinted and just didn't have enough gold in the vaults to do the exchange. So that led, of course, to the 1971 debacle, where President Nixon took America off the gold standard. So it's all. I read it. It's just about confidence. It really is. And the moment you lose confidence in a currency, it's ball game over.
Oh, absolutely.
And that's where we're heading globally at the moment.
Absolutely.
Yeah. It is.
And don't forget that more recently, Germany wanted to get some of its gold back and had a hell of a fight getting some of its gold back. I mean, we're not talking about all of it, but just some of it.
Correct.
And there's no doubt about it. It was Germany's earmarked gold.
Yeah.
Earmarked being the term that central banks use for full ownership, but maybe in someone else's vault. So, the Americans just should have said, fine, okay, boom. So why didn't they?
Yeah.
They didn't because they didn't have it. That's the only conclusion you can come up with. Now, that's actually very concerning because the Federal Bank of New York is responsible for all the foreign-owned earmarked gold in its vaults. And the signal that sent, which was also picked up by the Netherlands Central Bank, was that the gold is not there. This is something. I think it's Warren Buffett said, when the tide goes out, you see who's not wearing swimming trunks. That's, I think, actually what is going to be another aspect, I think, of the collapse of fiat currencies.
Yeah. I was about to say before you added. Anyway, Darryl, before you close tonight, I will add something that came to my mind when you were talking about the Canadian Central Bank having no gold. Well, we're not too far behind, Alasdair. The facts and the figures in the Reserve Bank of Australia apparently owns 80 tonne, right, which is a huge sum of gold, but 80 tonne. But 77 tonne of that gold is in the Bank of England. So everybody be careful of what you think about the strength of the Australian dollar. And,
Alasdair, look, once again, it's amazing how quickly time flies. But thank you so much for your ongoing input into As Good as Gold Australia. It's not just our discussion here tonight or next month or the month after. It's all you do for As Good as Gold Australia. So very appreciative. And we're just very fortunate to have somebody of Alasdair's ilk on board with our company. We'd also like to thank our viewers and subscribers, of course, because they continue to support this channel and they do it wonderfully well. So we're appreciative of that. I'd like to close by reminding everybody of where our initial information came from and how important it was to us to connect with a gentleman by the name of Peter Daniels, who educated us on sound money a long time ago, 40 years ago. And I will never forget his statement when he said, I do not care what poorly executed economic decisions are made in the world tonight. Tomorrow, I'll still be able to party. Why would he be able to party? Because he owns gold. He owns real money. And so he's protected his wealth. And of course, Egon von Greyer's, whose fabulous quote needs to be reconfirmed. And Brian,
it's how much money do you put into gold and silver? Whatever you can't afford to lose. And it's a brilliant statement.
Absolutely. Thank you again, Alasdair. Really appreciative. Thank you to everybody. Until we meet next time, stay well, stay focused. And goodbye for now.
And goodbye for now.